Before we get into this, I want to ask you one question, and I want you to actually think about it before you answer. How much money do you currently have sitting in a regular savings account right now? Whatever that number is, a few hundred, a few thousand, more. Here is the follow-up question. Do you actually know what that money is doing while it sits there? Not what you assume it is doing, what it is actually doing. Because most people think their savings account protects their money, and by the end of this video, you are going to see that for most people, with most savings accounts, the opposite is true. And the math behind it is something your bank has absolutely no interest in showing you. If you have never had anyone walk you through this clearly, this video is going to hit differently. And if you are someone who has been putting off investing because it felt complicated or risky or like something that was not quite for you yet, stay right here. Because the step-by-step guide we are going through today was built specifically for that exact feeling. Drop a comment right now before we even start. Just tell me, are you currently saving, investing, or somewhere in between? I read every single comment, and your answer is going to shape what I build next. Let's get into it. You have been doing the right thing. Every month, a little goes into the savings account. You do not touch it. You watch it sit there. You feel responsible. You feel like an adult who has finally figured something out. And the bank sends you a little notification every few months showing you what you earned in interest. And you look at that number and feel a small, quiet flicker of pride. And then you do the math. Not the bank's math. Your math. The real math. The one that accounts for the fact that while your savings account has been sitting there collecting 0.38 cents on every $100 you gave it, the price of everything you actually need to buy with that money has been climbing at more than 10 times that rate. Your savings account is not saving you. It is slowly, politely, completely silently losing the race on your behalf. And the most painful part? You never permitted it to lose. You just never knew it was running. This is boring finance knowledge. We dig into the financial mechanics that most people find out about 10 years too late. The ones that change not just what you do with your money, but how you understand what money is actually doing when you are not looking. Today we are going through exactly why 2026 is the most important year you could possibly make one specific shift with your money, from saving to investing, and a step-by-step, genuinely lazy guide for doing it in a way that requires almost no ongoing effort once it is set up. If that sounds like the exact thing nobody explained to you when you first opened a savings account, stick around. Because that is exactly what this is. The savings account lie nobody told you about. Let us start with a number the bank would rather you did not spend too much time thinking about. As of right now, the national average interest rate on a regular savings account sits at 0.38%, not 3.8%, not 38%, 0.38, which means if you have $10,000 sitting in the average savings account right now, the bank is handing you back $38 a year in interest. That is roughly $3.17 a month. That is less than most people spend on a single cup of coffee. Now here is the number sitting directly across from that one. As of right now in 2026, the inflation rate is hovering around 4.2%, which means the purchasing power of your money, what it can actually buy in the real world, is shrinking by 4.2% every single year. Your savings account is earning 0.38% and losing 4.2% simultaneously, and the gap between those two numbers is the part nobody puts in the brochure when they encourage you to open a savings account. Run that out in real terms. You put $10,000 into the average savings account today and leave it completely alone for 5 years. The bank gives you back a little under $200 in interest over that time. But the real purchasing power of your money, what that $10,000 can actually buy in the world, has dropped by somewhere close to $2,000. The big bank account loses over $3,000 in real purchasing power over 5 years. In plain terms, you are getting poorer by saving. Read that line again, slowly. You are getting poorer by saving, not by spending, not by gambling, by doing the exact thing you were told was responsible. The savings account was never the finish line. It was always just the waiting room. The question is what you are supposed to do after you have built your cushion, and almost nobody ever explains what happens next. If you have never heard this explained this plainly before, you are in exactly the right place. Hit subscribe right now. This channel exists to keep explaining the financial mechanics that somehow never make it into the mainstream conversation until it is already too late. One tap, it is free, and it is the only way you see the next one. What investing actually means, and why most people never start. Before we go any further, let us deal with the thing sitting in the room that nobody wants to say out loud. Most people hear the word investing, and they picture one of two things. Either a Wall Street trading floor full of people in suits shouting into phones, making and losing fortunes in the space of 30 seconds, or a very boring, very old man in a cable-knit sweater telling them to be patient for 30 years in exchange for a retirement they may or may not live to enjoy. Neither one of those pictures is inviting, and neither one of them is accurate for what we are actually talking about here. Investing, in the version we are covering today, is this. You put money into a simple account that owns a small piece of hundreds of different companies. It grows as those companies grow, and you leave it alone. That is it. No charts, no daily checking, no sweating over earnings reports, no picking stocks, no special knowledge required beyond what you are going to have by the end of this video. The reason most people never start is not that it is hard. It is that nobody ever walked them through the first steps in plain language, and the gap between, I should probably invest, and I have actually started, turns out to be large enough that most people just never cross it. They stay in the waiting room forever, watching their savings quietly erode, telling themselves they will start when they know more, when they have more, when things feel more stable, and those conditions almost never arrive. So today, we are going to close that gap, step by step, lazily. Quick pause. If you are watching this and thinking I genuinely wish someone had shown me this sooner, tap the like button right now. It takes half a second. It helps this video reach the people who need it most, and it costs you absolutely nothing. The real numbers. What investing does that saving never could. Before the steps, you need to feel what the difference actually looks like in dollars, because feeling it is what makes people actually move rather than just nod and scroll on. The S&P 500, the index that tracks the 500 largest companies in America, has delivered an average annual return of around 10% since 1957. As of December 2025, the average annual return over the past 40 years stands at 11.5%. Not every year. Some years it goes up 25%, some years it drops 18%, and some years it does almost nothing. But averaged across decades, the number lands around 10% per year. Now, let us put that next to your savings account's 0.38% and see what the math actually does. You take two people, both 30 years old, both have $10,000 sitting in a savings account right now. Person A leaves hers exactly where it is. Person B moves hers into a simple, low-cost S&P 500 index fund and does nothing else for 30 years. At 30 years, Person A's $10,000, adjusted for what inflation did to its purchasing power, has shrunk to something closer to $4,000 or $5,000 in real value. Person B's $10,000, growing at roughly 10% a year and compounding on itself, has grown to over $189,000. Same starting amount, same 30 years, different account. That is the entire difference. Consistent monthly investing of $500 for 30 years at 10% produces over $1 million. This is the power of compound growth, and why starting early matters far more than the exact amount you start with. Now sit with something uncomfortable for a second. If you have had money sitting in a savings account for the last 5 years, you have not been standing still. You have been moving backwards. Every year you stayed in the waiting room was a year of compound growth you handed back to the market without collecting it. Those years do not come back, but the next 30 do. I want to ask you something directly. If you had known 5 years ago what you just heard in the last few minutes, would you have made a different decision with your money? Drop your honest answer in the comments. Yes, no, or I already knew and still did not move. Every single comment gets read. And if your answer is yes, keep watching, because the actual steps are coming right now. But wait, what about risk? Here is the objection that lives inside most people's heads when they hear these numbers, and it is a completely fair one. What if the market crashes and I lose everything? Let us deal with this honestly, because pretending the risk does not exist would make this video useless. Yes, the market goes down. It went down in 2001. It went down hard in 2008. It dropped sharply in early 2020. In 2022, the S&P 500 fell by over 18% in a single year. These are real events, and they feel genuinely terrible when they are happening. But here is what the long view shows. Negative years happen, but they are temporary. Patient investors who stay invested through downturns capture the long-term average. The market has recovered from every single one of those drops. Every single one. The people who stayed invested through the frightening stretches are the same ones who captured the recoveries that followed. The people who panicked sold, locked in their losses, and missed the climb back up. This is why the lazy approach, investing automatically and then deliberately not watching, is actually the most effective one. The investors who do the worst are almost always the ones who watch too closely, react too quickly, and let short-term fear override a long-term strategy that was working perfectly fine before they interfered with it. The risk of the market dropping is real. The risk of doing nothing is also real. The difference is that the market's risk is temporary. Inflation's erosion of your savings is permanent. If this is the first time someone has laid out both sides of that risk equation clearly for you, the risk of investing versus the risk of not investing, share this video with one person who needs to hear it. One share. And if you have not subscribed yet, now is the time. We are about to get into the actual steps. The step-by-step lazy guide. How to actually do this. Here is the full, honest sequence. No fluff, no steps designed to make this feel more complicated than it is. Step 1. Protect the foundation first. Before you move a single dollar into any investment account, you need to understand what should stay in savings, because savings accounts do have a legitimate job. They just are not supposed to be the final destination for money with a longer horizon. The money that belongs in a savings account is your emergency fund. 3 to 6 months of essential living expenses, rent, food, utilities, transport, sitting somewhere you can reach it instantly if something goes wrong. That money should stay liquid, accessible, and not invested, because the whole point of an emergency fund is that it is there the day you need it, not the day the market feels like cooperating. A solid high-yield savings account is paying around 4% right now, which is at or near the inflation rate, making it one of the few times in recent history where savings accounts offer meaningful protection for short-term cash. Put your emergency fund there, not in the big bank account paying 0.38%. That one move alone earns you roughly $400 more per year per $10,000 saved for doing nothing beyond opening a different account. Do that first. But everything beyond the emergency fund, every dollar that does not need to be available tomorrow morning in a crisis, that money has a better job available. And keeping it in a regular savings account is the most painfully expensive mistake in personal finance. Real quick, where is your emergency fund sitting right now? A big bank paying almost nothing? A high-yield account? No emergency fund yet? Drop it in the comments. No judgment at all. This is genuinely useful, and it helps me build the next video around where most of you actually are right now. Step 2. Open the right account. The account type is where most people stall, so let us make this simple. If your employer offers a 401k with any kind of employer match, that is your starting point. Not because it is the best investment vehicle in every circumstance, but because an employer match is free money, a 50 or 100% instant return on every dollar you contribute up to the match limit, before the investment even does anything. There is no savings account, no investment, nothing in financial history that gives you a guaranteed 50 to 100% return the moment you deposit. Always take the full match before doing anything else. If your employer offers no match, or you are self-employed, or you want to invest beyond the employer match, the next account is a Roth IRA. You contribute after-tax dollars, the money grows completely tax-free, and you pay nothing when you withdraw it in retirement. In 2026, the contribution limit is $7,000 a year, or $8,000 if you are 50 or older. You open one directly through Fidelity, Vanguard, or Charles Schwab in about 15 minutes online, and you need no special knowledge or credential to do it. If you have maxed out both of those, a regular taxable brokerage account at any of those same brokerages works fine for additional investing beyond those limits. The account itself is not the investment. It is just the container. What goes inside it is the next step. Step 3. Choose what to put inside it. This is the step that causes the most paralysis and deserves the least of it. You do not need to pick individual stocks. You do not need to understand quarterly earnings, price-to-earnings ratios, or what a particular CEO said on a call last Tuesday. You need one fund that does all of that for you automatically across 500 different companies for a fee so small it barely registers. That fund is a total market or S&P 500 index fund. Specific options right now include VOO, Vanguard's S&P 500 ETF, with a 0.03% expense ratio and a 5-year annual return of 13.6%. FXAIX, Fidelity's 500 Index Fund, at 0.015%, or SwapX, Schwab's S&P 500 Index Fund, at 0.02%. The differences between them are negligible. Pick one. Buy it. Stop looking at it. What you are buying when you buy one of these funds is a small piece of the 500 biggest companies in America: Apple, Microsoft, Amazon, Google, and 496 others, in a single purchase. When those companies grow, your investment grows with them. When one struggles, it barely matters because you own 499 others. You are automatically diversified across the entire economy without making a single individual bet. This is the investing equivalent of putting the cruise control on and trusting the road. If investing just went from feeling like a secret club to something you could actually start this week, give this video a like right now. And if you are not subscribed yet, do it before the next step, because step 4 is honestly where the real magic happens and you do not want to miss it. Step 4. Set up automatic contributions and then leave it alone. This is the step that separates the people who invest from the people who mean to invest. Go into your brokerage account, your 401k settings, or your IRA contribution page and set up an automatic recurring investment, a fixed dollar amount, on the same date every month, ideally the day after your paycheck lands, going directly into the index fund you chose in step 3. Even if it is $50 a month, even if it is $20, the amount matters less than the automation, especially at the beginning. Here is why automation is the whole strategy and not just a convenience. When you invest automatically, you invest during the months the market is up and during the months it is down. The months it is down are actually the months you want to be buying because you are getting more shares for the same dollar amount. This is called dollar cost averaging, and it is one of the most reliable wealth-building strategies in existence. And it happens completely by accident when you set up an automatic contribution and stop thinking about it. The biggest mistake investors make is selling during a downturn and locking in losses. Automation prevents this by removing the human decision from the equation entirely. You never have to decide whether this month feels like a good time to invest. The decision was already made on the day you set up the transfer by the calmer, more rational version of you who understood the long-term plan. Set it up once. Increase the amount when you get a raise. Otherwise, leave it completely alone. Step 5. Stop checking it constantly. This sounds like advice someone's grandmother would give, and it is the single most evidence-backed piece of guidance in this entire video. Fidelity famously looked at which of their accounts performed the best across all their customers. The answer was the accounts belonging to people who had either forgotten they had them or were dead. Not because death improves investment strategy, but because those accounts were never touched. No panic selling, no moving things around, no trying to time anything, just automatic contributions compounding quietly in the background, completely undisturbed. Your index fund is going to go down at some point. Possibly soon, possibly a lot. That is not a malfunction. That is the nature of markets, and it is temporary. Every drop in market history has been followed by a recovery and then a new high. The only people who lost money permanently in those drops are the ones who sold while the market was down and missed the climb back up. Check your investment account once a quarter, just to confirm everything is still running properly. Do not check it daily. Do not check it when the news gets scary. Do not show it to people at dinner. The less you interact with it beyond the quarterly glance, the better it will perform. Here is a question worth sitting with. Which of these 5 steps is going to be the hardest one for you personally? For most people, it is either Step 2, actually opening the account, or Step 5, not watching it obsessively once it is open. Drop which one is yours in the comments. Genuinely curious, and it genuinely shapes what I build next for this channel. The big shift in how to think about this. Here is the frame change that makes all of this feel different once it settles in. Saving is you keeping your money safe. Investing is your money going to work so you do not have to work forever. Those are fundamentally different jobs, and for most people, the money they have beyond their emergency cushion has been sitting in the safe category, doing the going to work category's job badly for years. Your emergency fund is an employee whose job is to be available immediately whenever called. It sits in a high-yield savings account and waits calmly. Good at its job, right tool, right place. Your long-term money is an employee whose job is to grow over decades. Keeping it in a regular savings account is like hiring a marathon runner and asking them to sit at a desk answering phones. Technically possible, genuinely wasteful. Wrong tool, wrong place. The shift is not complicated. It is one account for the emergency cushion and one account for everything else, both on autopilot, both doing exactly the job they are built for, and you largely forgetting about both of them until you are decades older and the numbers look very different from what they would look like if you had kept everything in the waiting room. If you know someone right now, a friend, a sibling, a partner, who has money sitting in a savings account and has been telling themselves they will look into investing soon, send them this video today. Not tomorrow, today, because soon has a way of becoming never, and this video is the 15-minute version of everything they need to hear to actually start. You might be the reason they actually do. The numbers that should make you move this week. Let me close with the version of these numbers that tends to actually make people do something rather than just think about it. Wall Street strategists, all 21 of the major ones surveyed, Expect the S&P 500 to post gains in 2026, with an average forecast of around 12%. Meanwhile, your regular savings account is paying 0.38%. Every month that passes with your beyond emergency money sitting in savings, instead of invested, is a month of that gap you are simply handing back. Here is the version that hurts the most. Two people, both 25 years old today. One starts investing $200 a month this month. The other waits 10 years, starts at 35, also at $200 a month, and contributes all the way until 65. 10 more years of contributions than the first person. At a 10% annual return, the person who started at 25 ends up with approximately $100,000 more at retirement, despite contributing less money in total, purely because of the 10 years of compounding they captured that the second person missed. 10 years of waiting costs $100,000 in that example. Not because of any mistake, not because anything went wrong, just because the money was not in the right room doing the right job. That is the cost of the waiting room. If any part of what we just covered changed how you are thinking about your money, even one sentence, drop it in the comments. Tell me which line hit hardest. And if this video was genuinely useful to you, the like button is right there. One tap is the only thing that tells the algorithm this is worth showing to the people who need it most. The one thing to do this week. Not 5 things. 1. Open a Roth IRA at Fidelity, Vanguard, or Schwab. It takes about 15 minutes and costs nothing to open. Put whatever you can into a total market or S&P 500 index fund. Set up an automatic monthly contribution, even a small one. Then close the tab and go do something else entirely. That is it. That is the lazy guide. 15 minutes of setup, one automatic decision, and you are no longer the person whose money is quietly losing the race without your permission. The savings account was never the destination. It was always just the first door. Today, we opened the second one. Subscribe to Boring Finance Knowledge right now if you have not already, because the next video builds directly on what we covered today. We are going into exactly how to choose the right index fund for your specific situation, what to do if you are starting with less than $100, and the one mistake new investors make in the first 6 months that quietly undoes everything they built. You do not want to miss that one. Subscribe, hit the notification bell, and I will see you in the next one.